everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 357 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to talk about why average investors are so horrible, right? Why they are so bad at actually investing. Right? And that may be many of you out there, and on average, it will be those of you out there. And so I want to talk about exactly why, as a group, the average investor is not good at what they do. I want to talk about by how much are the average investors actually missing out relative to what they could be making. And then ultimately, I just want to give you the major mistakes that the average investor makes to leave them with lower returns than they could have made otherwise. All right, so all these things culminate into what it takes to be a good investor, and the fact that many people just are not displaying those characteristics. So stick around for a discussion of all that and more in today's episode. Before we get started, though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now look, I know that we all have these friends, and we all have these acquaintances even, who talk about all the great returns that they make in the stock market, right? And they talk about how they made all this money on Tesla and all this money on crypto and all this money on, whatever else, right? Whatever other thing there is. Maybe, people are making a ton of money on NFTs or just whatever, right? Things that aren't necessarily just the stock market. But people tell you about all their wins, right? They tell you why they are so great. Well, if people are so great, then why does the average investor underperform, right? What mistakes are the average investors making that leads to underperformance, right? And you may say, well, then I'm not the average investor. I can't be the one underperforming. Yeah, that's you, right? More than likely, that is you. So this is just something from earlier this year. It's back at the end of August. This article says that the average equity investor, so stock investor, lagged the S&P 500, the stock market index, by 2% in the first half, right? So it was 2.1% through June 30th, the mid-year Dalbar QAIB report stated, okay? So the average return gap between the average equity fund investor and the U.S. equity market has widened considerably in the first half of 2021, doubling from last year, doubling from 2020. Now, worse than the average equity fund investor making 13.14%, while the S&P gained 15.25%. Worse than that, the average asset allocation fund investor earned 8.31% in the first half, which lagged the S&P by 6.94%. One major reason for the lagging performance is the average equity fund investor was also a net withdrawer of assets in the first half, withdrawing 1.5% of assets in the first 6 months of the year. Okay, but regardless of what happened with withdrawals or whatever else, the average equity investor is lagging. Okay, and then we have to ask ourselves why. Well, just first and foremost, I think one place that we can look is the fact that we don't hold things for very long. Look at some of the richest men and women in the world. What's their secret to success, right? Most of them have built businesses, right? But they've held ownership in those businesses for the last 30, 40, 50 years, and it has compounded to very large sums of money. Okay, just think about Warren Buffett. Warren Buffett, running Berkshire Hathaway for as long as he has, and his big thing is buying and holding good companies. Okay, and the average investor is just not doing that. The average investor has a crappy holding period for the stocks that they end up owning. So the average holding period for U.S. stocks has been declining for many years now. In the 1940s, the average duration was 7 years. So on average, in the 40s, if you were to buy a share of stock, you would hold that share of stock for 7 whole years. Okay, but by the turn of the century, it had fallen to below 1 year, according to an article in 2010. A recent study earlier this year by researchers showed the holding period for NYSE listed firms was 9 months, right? So investors were only holding the stocks for 9 months. And a Reuters article noted that the average holding period for U.S. stocks has declined to 5.5 months in June of this year from the article. So this is quite striking, right? It's quite striking that the average holding period is less than half a year for a share of stock. It's not surprising, but it's shocking because you have this ability to build wealth if you buy and hold good things for long periods of time. But we're so quick to just take a profit and move that we underperform the market, right? I would say that's probably one reason that we do underperform the market. But I want to talk about not just that potential reason, which we'll dig into that a little more here shortly, but I want to talk about 7 mistakes that the average investor needs to avoid if we want to stop underperforming the market, right? Because these are things that are all going to lead to underperformance over a long period of time. So the first thing is watching the markets, okay? Watching the markets move, constantly checking, apps, constantly watching CNBC. Look, I, as much as anyone, like to look at the value of my investments. I like to watch CNBC. I like to, see what's going on. But I'm not necessarily doing it for anything else than, my own educational purposes, right? Rarely does it turn into an investment decision if I decide to watch or listen or whatever. I'm just trying to gain more information and keep up with things, see how things are going. But for many people, constantly watching the markets becomes an exercise in losing money, right? Because they'll, hear something about a company that they're invested in. They'll see the company, dip down over a short period of time and they'll want to sell, or they'll see it going up and they'll want to buy, which both of those things are the opposite of what you would want to do with a good business. You would like to buy it on sale and you would like to sell it when, it looks like it's increasing in price substantially, right? But people watching financial markets, it gets you very anxious. It gets you very jittery. It makes you want to act. It doesn't make you want to sit by passively and just allow your money to continue growing. It makes you want to do things. And ultimately, the more that we do, the higher likelihood we have of the thing that we do being stupid. Okay? And I don't want you to make stupid mistakes in your investing life. I want you to make good, prudent investing decisions. The only way that you're going to do that, the only way that most people are going to be able to do that is if they stop looking, right? Buy things that you know are going to go up in value over a long period of time, whether we're talking individual companies or just passively investing. If you're passively investing, there's no reason for you to watch markets, period, right? Because you should put money away and not pay attention to it, right? Because passive indexes, they are just going to track an index. And, if that's what you're going to do, then, you shouldn't be surprised when you get what the index gives, okay? So there's no reason to really ever watch what your performance is looking like there. But even if you are investing in equity mutual funds or bond mutual funds or whatever that are highly diversified and things like that, there's really very little reason to spend a whole lot of time looking at what they're doing. The people who spend the most time watching the markets are typically those who are invested in individual securities, individual stocks, individual bonds, crypto, all those different types of things. And they, will make you act, right? The market will make you act in an irrational way. And, CNBC will make you act in an irrational way, right? So we have to work against this by not constantly watching the markets because what do you think's happening, right? What do you think's happening when you are, watching the market and let's say you do own an individual stock and that individual stock drops 5%, right? And you decide, okay, I'm not in for this, I'm selling. Well, what happens when it reverses from there and goes up 55%, right? You miss out on all those returns. I'm not saying that's always what happens. I'm not saying that that should be expected on average. I'm just saying it does happen, and it is a very big reason why we miss out on returns and underperform relative to the major market indexes. Now, apart from watching the markets, right, we also need to make sure that we are not chasing trends. Now, I say this as I understand that most investors, or quote unquote investors, do nothing but follow trends, right? They do nothing but follow what the market is saying at any given time, right? But again, if you look at some of the most successful investors over a long period of time, something that they have a knack for doing is not chasing the trends, right? Not chasing what the market is doing at any given time. If anything, they go against the trends. If anything, they are contrarian, right? If anything, if a bunch of stocks are going up and then there are others that are out of favor, they buy the ones that are out of favor because they know that at some point those will come back into favor in the market, right? So chasing trends is not worth our time, and it's only going to leave you most of the time behind where you could be if you were at the front of that trend, right? And the people at the front of that trend, guess what? They're not just jumping on a bandwagon. The people on the front of a trend, they were the ones that bought these things when they were out of favor, bought these securities when they were out of favor, and have allowed them to continue to increase in price over time and have made a lot of money, right? But people chase trends, right? How many people jumped on the Tesla bus in the last few years? So many, right? How quickly did crypto catch on, right? And how miraculously did crypto catch on? And NFTs, how quickly did they catch on? All of these things, right? Even though those are pure speculation, vehicles, how quickly did they catch on with the investing public? Very, very quickly. Now you look on CNBC and where you see the Dow and the S&P and the NASDAQ in the bottom right corner, you also see the price of Bitcoin and the price of Ethereum, right? So trends do catch on even among the major investing public. But a problem that we can have when it comes to trying to make good returns is following trends. Okay, because typically we're going to be too late. We're going to be beaten by the very fast movement of the market. By the time you hear about something as an individual investor, you've really already lost your informational advantage. Okay, so going and finding things that are undervalued on your own, if you are buying individual securities, is the way to go. And then again, ultimately, if you are a passive investor, you should never ever chase the trends, right? As a passive investor, you should just keep investing in the index funds or the mutual funds that you've chosen for yourself, and just keep putting money away, and do not deviate. Do not deviate and chase any type of trend, because it's only going to leave you with worse average returns, okay? Now, along with chasing the trends is the third mistake that we want to avoid when it comes to our investing, and that is following bad advice from social media. Okay, this has been just the downfall of so many people who wanted to get involved in financial markets, and all of these things, right? The chasing the trends and bad advice from social media, things like that. It speaks to our gambling mindset, right? It speaks to our mindset of trying to speculate and make quick returns and get rich quick. Right? For some reason, that is where our minds, kind of default to. And social media can really make you act, right? If you don't think social media has an intense impact on your life, then you're crazy, right? Social media can make you act, and it can especially make you act when you hear people that you think are credible on social media talking about some particular investment vehicle, right? Or some way in which you can speculate with your money, right? And they'll make it sound fantastic. There's a plethora of YouTube videos that will make you think that you should put every single dollar that you have into Bitcoin, right? But the individuals who put out that content, they aren't benefiting from the fact that you go out and buy it, right? They are just saying what they need to say. Wrong, right? They are benefiting. They will benefit, because as you buy whatever it is, they will benefit by the increase in price. And again, you will be later because you lost your informational advantage because you heard it from them, right? And they were some of the first movers. They were some of the people who led the trend, maybe. And now you're following bad advice, and you're on the back end of a trend, and you're losing, and you're not making the returns that you could make otherwise, right? And I'm talking about something like crypto here, but it's so true as well for stocks, right? How often do we see, I mean, even somebody super credible, right? So I'll say like Jim Cramer, right? Somebody super credible tweet about certain companies, right? And then you want to jump on the bandwagon for those particular companies. Well, how many people do you think saw those tweets? And how many people do you think jumped on board? And how many people do you think had already heard about this stuff from his show or from his investing club with CNBC, right? How many times had he already said this and had people act? And so again, following bad advice is one thing, but even when it can be good advice, right, it can be bad for you because it can make you, one, deviate from your investment strategy in the first place, and then two, make you act on something that you do not actually have an advantage on, and you think that something that 3 million people saw on social media gives you some advantage. It probably does not. Okay, proper investing requires that we do our own research. It requires that we make decisions based on the things that we know, we understand, and we do research on. Okay, so the worst thing that we can do is look to social media for the advice as to how to invest, because most of the time, social media is not pointing you to investing. It is pointing you to speculation. It is pointing you to gambling, and that is not the same as investing your money over a long period of time, which is what I'm trying to teach you guys how to do on a day-to-day basis. Now, the fourth thing here goes along with one of the things that I think is the biggest driver of underperformance, especially in equity markets, by the average investor, which I talked about at the beginning of this video, and it is not giving your investments time to grow. Right, so it goes back to the whole holding period of U.S. stocks being just 5.5 months, right? And no telling what it is now, but that last data point that we had there, 5.5 months, is how long retail investors, average investors, are holding shares of stock. Now, why is this a problem, right? Why is this a big issue that we're not giving our investments enough time? Well, time is one of the biggest factors in growing your money. Just period. Time is one of the biggest factors in growing your money, right? When you think about the time value of money and you think about the formulas by which your money actually grows this way, right? The biggest impact that you're going to have is the rate of return and the amount of time, right? Because you can make, 12% rate of return or whatever it is, but you do it for a short amount of time, it's not going to be super beneficial to you. But the more time you give your money to grow, the more time you allow your money to compound and grow and compound on itself and continue to make interest on interest, then you will be far better off. So let me just give you just a quick example, right? Let's say that we begin with $10,000, okay? And we invest in let's say the stock market, and you make 10% per year. Okay, if you made 10% per year in the stock market for 20 years, starting with $10,000, right, you would end up with $61,159. Okay, so your money would have multiplied by a little over 6. Okay, which not shabby at all. Okay, but let's say you started with the same $10,000, and instead of 20 years, let's say we just invested that money for 40 years. Now, obviously, these are extreme examples compared to the holding periods that individuals have in the market today, but these create bigger numbers, and it's more enticing, and it sounds better, but it is very, very true, right? So if you hold that $10,000 invested at 10% twice as long, how much money do you think you have? Do you think you have twice as much money? Wrong. You have $411,447.78 compared to the $61,159, right? So we're talking about a $350,000 difference by just holding this same investment for twice as long, right? So time makes a huge difference because twice the time is not twice the money. Twice the time is way more than twice the money, right? So we have to give our investments time to grow. We have to have strong investment thesis and allow the stocks that we own, the index funds that we own, mutual funds to grow over time. Look, you hear people talk all the time about, hey, if you would have gotten in on Amazon way back in 2000, or if you would have gotten in on Netflix at this time, look at how much money you would have made and all this type of stuff. And what I really wonder is that has anybody other than the insiders on the company actually made that much money? I doubt it, because we do not like giving our investments time to grow. And I'm not saying people haven't made great returns on those companies, but do people actually have the patience to let their investments grow? If you do, you're far more likely to create outperformance in your portfolio, or at least market level performance. Now, the fifth mistake that we can make as average investors is investing money that you will need too soon. Okay. Now, this can be a big problem, again, because we're not giving our investments time. Okay. First off. But if you're investing money that you'll need too soon, at the first sign of it dropping, you're not going to be willing to just stand in there and take it on the chin, right? If you're going to invest money that you don't need for the next 25 years or 40 years or whatever, right, you're going to be far more likely to take some losses and just continue on, okay? But if you take some losses on money that you're going to need in a year or in 2 years or whatever, right, then you're far more likely to just pull that money out of the market in general, which is going to have a negative impact on the average return that investors make. Right. And this is why I tell you guys, if you can't have your money invested for at least 3 to 5 years, you don't need to have it invested at all. Right. Put it in a money market, put it in a savings account, whatever. Right. And people say, oh, well, you're losing the potential. Well, you're also losing the potential to lose some of that money and get so scared that you run with your tail between your legs out of the market. Right. So ultimately, investing money that you'll need too soon is a problem, and it will keep us from making outsized returns. So only give yourself proper amounts of time to invest, 3 to 5 years at minimum. Otherwise, just save the money, don't invest it. Then the sixth investing mistake that we can make is having unclear goals. Okay, and this mistake again can keep us from making excess returns in the market. Okay. So let's just think about this. Let's think about what we're talking about here. Having unclear goals, not knowing why you are investing your money, not knowing what you are going towards, what you are moving towards, what you want to do with your money. Because what have we talked about before? We've talked about recently multiple times, right? I've talked about the risk taking that we do in our portfolio, and how that risk taking is, or should be, maybe not is, but should be based on 3 factors, right? It should be based on our time horizon, right? Which we talked about time in the market here, right? It should be based on our time horizon. It should be based on our investment objectives or investing goals, like we're talking about here. And it should be impacted by our own personal risk tolerance, okay? So our investing goals impact how much risk we are willing to take in a portfolio, how our asset allocation looks, or whatever else. And so if we don't know what our investing goals are, we're also unclear on how much risk we should take. And so we are likely to take the incorrect amount of risk, right? And if you take the incorrect amount of risk, then you're likely to end up underperforming, right? Because then you're going to be all over the place with your money. You're going to be trying to figure out, do I want to invest in this or do this or take this much risk or this much? And there's going to be a lot of ambiguity there when it comes to having unclear investing goals. Look, once you have savings set aside that you can fall back on, you need to make sure that you have clear investing goals, right? Investing to make more money is rarely a good goal to have, right? Even though, yes, we're all trying to grow our money, that's rarely a good goal. Instead, people should see money as a tool for meeting their other goals. Making investing all about returns is a common mistake. Okay, you don't have to chase high returns that are also correlate with higher risk if you can adequately meet your goals with less risky investments. And that's a problem, right? If we don't know our goals, then we may over allocate towards risk assets and then underperform because we get scared out of those risk assets at the first sign of any negativity. Many investors use the S&P 500 as a benchmark for their investment performance, but the index is not often a fair comparison against actual portfolios. right? It serves as a proxy, but that proxy is not a perfect one. And again, this talks about the actual risk that we're taking, the actual portfolio that we're putting together, and whether or not that type of benchmark is commensurate with the goals that we have. So if we know our goals, if we know our investment objectives, we'll take the proper amount of risk and likely stay in the market longer with the proper portfolio under our belt. Then the seventh mistake, and probably the biggest, I would suggest, probably the biggest mistake that can be made, even though a lot of these mistakes are very big and can cost you a lot of money. The biggest mistake that keeps investors down, that keeps the average investor from making the returns they could, is delaying investing altogether. Okay? For one reason or another, people choose not to invest. For one reason or another, they choose not to put money away for their future. Right? And we justify it, right? We justify all the reasons why you can't, or you're not able to, or you have other things that you have to do, or why would I do that when I can do this, or whatever, right? And the truth of the matter is that if you delay investing too long, then you'll lose, right? Financially, you will lose if you do not invest for too long, right? I'll just give you a pretty clear-cut example of this exact thing, right? So let's say, again, that we started with a $10,000 investment, right? And that $10,000 investment was made by a 20-year-old. They held it for 40 years. They got to that $411,000 number that I was talking about earlier. Well, let's say that somebody didn't begin investing until they were 40, not 20, but 40, right? And when they were 40, they began with not $10,000, but $50,000. Okay, and you may say, okay, that may actually make a difference on the amount of money that they have relative to the 20-year-old. Well, you would be wrong, right? They would still underperform the 20-year-old by the time the 20-year-old turned 60, and by the time that individual turned 60, they would underperform the 20-year-old by over $100,000, right? So just because you start with more, right, and here we're saying 5 times more, the fact that you took so long to begin, it can eat away at your ability to build wealth over a long period of time, right? Time is our friend, right? So investing as soon as possible is very, very vital. It's very, very important. Now, I don't want you to take this as me saying, hey, regardless of where you're at financially, you need to go invest today. I don't want you to hear that from me, okay? I still want you to follow the steps of the financial action plan, which are what? I want you to uniquely budget. I want you to have the 1 month of household expenses set aside. If you have a 401k after you set aside that 1 month of household expenses and it offers a match, just take the match. Then get out of consumer debt. Then have 4 to 6 months of household expenses set aside in an emergency fund, and then begin investing at least 15% of your income for your future, right? So yes, does the financial action plan call for delaying investing until you build a financial foundation? Sure. Right? But how long should it really take to build that financial foundation? Unless you've created a huge mess for yourself, not too long, right? Typically, you can get those things done in no more than 2 to 3 years if you are very serious about getting your financial foundation set, right? And if you can do that, then you can begin investing and doing all of the right things in your financial life with a firm financial foundation below you, right? But ultimately, right, we don't want to delay investing. We want to begin as soon as we can so we can build money over time and we can continue to compound money as long as possible. Because many people have posited that, Warren Buffett made great returns back in the 80s and 90s, but since 2000, he really hasn't made the best returns. And but the reason that he is one of the richest people in the world is because he's given himself such a long time horizon. He began investing in stocks when he was just a little kid, right? So he didn't delay investing at all. And it's gotten to this point. I'm not saying that everyone begins investing as a kid will become a billionaire, but they'll have a far better chance than the person who waits until they're 40 to start investing for their future. Look, retirement is going to come one of these days. You are going to need money one of these days. You're going to want money to do the things that you want to do one of these days. So why not do it in the proper way? Why not invest early, invest often? Don't watch the markets too much. Don't chase the trends. Don't take bad advice from social media. Give your investments time to grow. Invest money that you can give time to grow, right? That you won't need very soon. Have clear investing goals and do not delay. Begin as soon as you can. All of these things together are going to help you to be the most effective investor that you can be and hopefully not underperform the index for far too long. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.